Welcome to video 7-1 where we go over the beginning of variance analysis. In this video, I'll talk about the theoretical framework for variance analysis, tie it into some of the concepts we've been talking about throughout the whole book, and also go over the revenue variances. So with variance analysis, we're trying to assign responsibility for revenue and costs. Again, as we've been doing for a lot of the book here. We assigned in Chapter 2 costs and revenues to individual alternatives. We put them up in a table. In Chapter 3, we assigned costs based on their relationship to volume. They were variable or fixed costs, and so we were able to assign them to different areas of the continuum of volume that we could choose. And Chapters 4, 5, and 6, we talked about how to splice up costs, product costs specifically, that could then be help us understand how much each product unit costs. Variance analysis here, sometimes a textbook will have a chapter on this and we'll call it standard costing. We'll get to that in a second later in this video. But the basic gist of it, so you understand why these two are used synonymously, is you can't do proper variance analysis unless you have standards, specifically a standard price and a standard quantity. Those are the two keys, because otherwise you won't be able to break down your variances to small enough units that you can make decisions on them. So therefore, standard costing and variance analysis go together. Now, the underlying variance analysis theory starts with a couple definitions here. Variance is simply the difference between budgeted results and actual results. Specifically, if it helps you to keep things straight, you want to do this alphabetically and have actual minus budgeted results. If you always keep that straight, and all of the formulas in this chapter should be arranged that way, then you will have this rule of thumb that you can follow, and your variances will be either unfavorable or favorable. You can transfer if you keep the actual in front of the negative sign and the budgeted amount to the right of the negative sign, the minus sign. Then if there's a negative result, then that's unfavorable revenue variance and a favorable cost variance. This makes sense, because if there's a negative result, that means that the budgeted amount, which is on the right-hand side of the minus sign, is greater than the actual amount, which is on the left-hand side of the minus sign. And if your budgeted amount was greater than what actually happened in terms of revenue, that's not good. That means reality fell short of your expectations. If it's negative in terms of cost, that's favorable, because that means actual costs fell short of your expectations of cost. And the reverse is also true. If the difference is positive, again, actual minus budgeted, if the difference is positive, then we're talking about favorable sales variance. Reality, the more actual number, was higher and exceeded your expectations. It exceeded the budget. And if it's cost, that's not good, because that means the actual number exceeded the expectation. Now, this is a very general way of looking at it. I made some very sweeping statements there, like, oh, that's not good. In some instances, like the volume variances for cost variances, that's not really a negative thing. Well, we can cross that bridge when we come to it. But regardless, so you have variances. You might already be very familiar with this already, but let's just get some definitions out of the way. And you can use the negative sign of your subtraction to figure out if it's favorable or unfavorable. You can keep that rule of thumb. Now, often I don't keep close track of this rule of thumb. I really don't use this rule of thumb. I added it because some people really depend on it to figure out what's favorable and unfavorable. I prefer to really just logic through every variance independently. I'd prefer to think through what it means, because it helps me to then say what I or the company should do about it. So the other thing you could do is you could simply say, okay, well, which of these two is greater? Was actual greater or was budgeted greater? And I can simply say, well, if it's revenue, then if actual is greater, that's good. If actual was less than budgeted, then that's bad for revenue. And if it's cost, then actual being greater is bad for cost. Budgeted being greater is good for cost. So I really don't remember anything about negative signs. When I do the difference, say if there's 1,000 actual cost and $2,000 of budgeted cost, I honestly don't set up a minus sign in my head. I simply say, oh, well, the difference between those is $1,000. And I simply find the absolute value of the difference, and then I then go around and say, well, which one was greater? Okay, the budgeted result was greater. We're talking about a cost, so that's good news. Reality was lower in cost than we thought. Okay, well, I say that because some of you will memorize this rule of thumb as it's stated, and not my explanation of it, of why negative difference is unfavorable for revenue and favorable for cost, and a positive difference is favorable for sales, which is revenue variance, and unfavorable for cost variance. And you'll forget the why, and so you'll never make that bridge. And you might get some problems wrong, or more importantly, out in practice, you might not be able to interpret a variance as quickly or as fluently as you should be able to. And so you can create this at a very global level. You can get a total budget variance, a total revenue variance, total cost variance, total profit variance, just to get total variance between the budgeted amount and the actual amount. You can do that, and there are just vaguely some uses for that, but it's not nearly as useful as it needs to be. This is the rest of the chapter is largely about breaking down total budget variance into its component parts, breaking revenue variance down into its component parts, down to the level that will allow us to act upon the information in that variance and improve next period's results. Revenue variance, breaking it down. Cost variance, breaking it down. And thereby we've broken down total profit variance by breaking down these two. And I want to make sure I said that in there, because the reason you get variance is to get information that will help you change things for next period. Because the general gist of variance analysis is to understand actual profit this period as a function of your budget and the variances. So if you have the budgeted number and then the variances as well, if you combine those two together, then you will get the actual number. So remember, the variances are simply the difference between actual and budgeted. And so if you combine these in this function like this, then this R function as a whole is representing the actual revenue. Similarly, you have your cost budget, and then your costs varied from that through the actual results. And so you have this function combining these to represent actual costs. But it's important to understand that we're just slightly transforming the profit function to pull out this variance information, because we're going to use it for decision making. It's not critical right now to know mathematically how we combine these two or whatnot. But this is I want to make sure this is grounded in the same theory that we talked about since chapter 1. We're just redefining revenue and cost in a way that allows us to pull out these variances and say, aha, responsibility for actual results lies here, because that was where the variance is. And therefore, it implies a relationship across time. Our budget comes from last period for cost budget and for revenue budget. And we're going to use the information from the variances to help us do better next period, either to budget more accurately or to motivate our workers, or our managers specifically. All right, now let's talk about science. You have to have it with a capital S and a TM over the E. It's trademark science nowadays. People have treated science unwarrantedly with some metaphysical devotion. Ironically, actually, because science is supposed to be in some of its most pure form supposed to be our estimation of the rules of the physical world. So it's ironic that people attribute some metaphysical properties to the pursuit of science. But let's talk about science in general. Science is a process, and it's a series of bad and incorrect guesses. But the idea behind it as a process is that those guesses should be getting better. Now, there are lots of ways that this doesn't happen. I don't really want to get all anti-science in this. I myself am a scientist. I believe that the fundamental building blocks of science are good. I know that also there are some ways that it breaks down. There are ways in which scientists become very intellectually minded and very nose up and sure that they know more than other people. There's pride that comes into it, and arrogance that stymies the scientific process. You need humility to do it right. There's also groupthink that happens. Sometimes science is made to be much more incremental than it should be. It's very often very, very, very backwards looking. If you took all of the false predictions, the incorrect predictions from science, and put them in a book, it would probably be a book that would reach the moon. There are science can get a maybe it's best it can improve its guess about the future, but the guess about the future is so often wrong that it's not very good. So it's usually backwards looking, good about it's better at explaining past events than it is about predicting future events. That's because of its incremental nature. Future events are going to be complex, dynamic phenomena that often involve decision makers who will change their minds or change their actions based on contingencies and interdependencies. And so, your incremental experiment, which does like one manipulation, one thing that it's changing between two groups, it's not going to do a great job of predicting that very complex future. But again, the fundamental idea of science is the improvement of knowledge over time. And variance analysis is a company basically sciencing itself. It's trying to express in the budget, first of all, what it knows about itself, what we as a company think we will earn in revenue, and what we think we will spend in cost. And then we're going to do a careful test through our variances to see where reality does or does not support that hypothesis. And then we're going to use that to communicate to the decision makers that information so that we can improve our next steps going forward. We can improve what we do, either to A, adjust our expectations, or B, change our procedures so that we reach those expectations more efficaciously. So I like to go on a side here. I'm trying to keep this as brief as possible because I actually recorded a video of 7-1 before, and I just didn't like it. It lasted much longer than I wanted, and it explained things not nearly as well as I wanted. So I just want this brief aside. I want to get as much bang for my buck as possible. And I'll tell you about an experiment that I did. And this is why I call this quasi-scientific. So again, the story I'm going to go into is about an experiment that I did as a researcher. Because like I said, I am at my core a scientist. I believe in this process, even though it has its imperfections. But the purpose of it, before I go into the story, is to draw out what I mean when I say quasi-scientific responsibility assignment with variance analysis. And also, it will also help us understand a little bit, be a precursor to the next characteristic of variance analysis, which is that it suggests action. So, I once conducted an experiment in which I was testing to see how decision makers varied in their decisions based on whether they received a strategy map or not. Okay, so I have here a dependent variable, which is decision makers' decisions. I'm going to measure their decisions, and I have what I think will change. I think there will be whether they get a strategy map or not will affect that dependent variable. So I have an independent variable now, whether they get a strategy map or not. Now, when I designed that experiment, I had to be very, very careful when I took the two groups, gave one group a strategy map and one group not a strategy map. I had to be very careful to keep everything constant between the two groups, except for the independent variable I was manipulating, the strategy map. I wanted them to have exactly the same experience, exactly the same colors on the computer screen, exactly the same flow, exactly the same questions I was asking, the same wording as much as possible. The only difference I wanted was the independent variable I was interested in. Because, let me give you an example. So let's say group 1 is the strategy map group. Group 2 is not the strategy map group. Let's say I gave group 1 a set of goals, these 4 goals, A, B, C, and D. And I arranged them as a strategy map, which means you draw arrows between A, B, C, and D. And A, B, C, and D are arranged in the balanced scorecard categories. If that's Greek to you, don't worry. But the point is you have a certain setup that you do with a strategy map that that is specific to a strategy map. If I took group 2 and then gave them a whole different set of goals, E, F, G, and H, not A, B, C, and D, but new goals, E, F, G, and H, there we go, and also did not organize them into a strategy map with arrows between the goals and them in the balanced scorecard categories, I would have what's called a confound, and I would not be able to conduct the experiment. It would not have been published. It wouldn't have worked. No, this experiment needed me to be very careful, and I needed to give group 2 the same goals, A, B, C, and D. Otherwise, when I go later and look at the two groups and how they differed in their decision-making later in the experiment, I wouldn't know what caused it. The two groups differed in 2 important ways. 1, they had 2 different sets of goals. And 2, the goals were presented in a different way. Now, my stated purpose of the experiment was to examine how the presentation style affects decision. So we're talking about the strategy map portion. But I also have this this thing that is changing between the two, this lever that I'm pulling, the second lever that I'm pulling, of the types of goals. What if I wrote A, B, C, and D to be very simple goals? And what if I wrote E, F, G, and H as very complex goals? It could full well be the complexity of the goals that is driving the end result, the difference between Group 1 and Group 2, instead of the presentation in the form of a strategy map. So I had to be very careful. I had to make sure, and we talked about this over and over. Me and my, this is actually an experiment I conducted while I was a PhD student. So me and my advisor would talk about it over and over. No, we had, and I made sure I kept the goals constant between the two. The only difference was the presentation style. And so once I had that experimental control available, then I had isolated the only difference between Group 1 and Group 2 that was not randomized. I'll come back to that in a second. That was not the only difference that was not randomized was the strategy map, whether they received the goals in the format of a strategy map. And I also made clear there, in case you're wondering, it's not really critical to Chapter 7, but in case you're wondering, I said that was not randomized. Of course, I couldn't make clones of people and put one clone in Group 1 and one clone in Group 2. Yeah, we don't quite have the budget for that. But I was able to get a big enough group and randomly assign them between Group 1 and Group 2 that statistically I felt confident that I had randomized any differences in the group. It was very unlikely that all of the, I don't know, nervous people got in Group 1 and all the laid back people got in Group 2. All the smart people got in Group 1, all the not smart people got in Group 2. Very unlikely that sort of thing happened. And I was able to do some tests to make sure that randomization process was effective. So that, like I said, there are things that probably differ between the people in Group 1 and Group 2, but because of the large group of my sample size and the large number of the samples in these two groups of people, those differences washed out and became insignificant statistically when I did the final analysis. So anyway, that's why I can say with confidence that the only difference between those two that is of any significance, that wasn't randomized out by the process, was just my construct of interest, the presentation of the strategy map. So this has a parallel in variance analysis. Again, we can't do much with 7.1.2 here, total budget variance. There are lots of reasons why revenue might have been higher or lower than expected, why the actual amount might be higher or lower than budgeted. At least two. We could have had higher or lower prices, or we could have sold more or fewer units. With cost, well, let's talk about different types of costs. We probably had direct materials costs and direct labor costs and overhead costs. Each of those could vary on at least two different things. Did we use more of those inputs? Did each unit cost, or did we use more or less of those inputs? Like direct materials, we use more units of direct materials or fewer units of direct materials? Did each unit cost more or less? So lots of reasons that this could happen. And when we're just looking at actual revenue versus budgeted revenue, we're varying more than one thing between those two in comparison. It doesn't help. And so we need the standards. We need to do this variance analysis in the way that I'm going to describe in this chapter to help us break those down into a setup where you're only comparing one group to another group, and the difference between them is isolated. We have one difference between those two groups, and so therefore we can attribute any difference between those two groups to that one thing that has differed. Any different result between those two groups to the thing that we know has differed between the two groups. Okay, and thereby it suggests action. If we know what we can attribute the result to, it suggests an action. And I don't mean to say that we know for sure all 50 steps that we need to complete over the next 5 years. This is not some magic psychic process. But it with a little investigation, we can understand. Once we have an actual variance, we have enough information that with just maybe a little more investigation, with a little bit of fact finding, we can take action on it. And that's usually where people stop. They don't go further than that because managers are expect to have to make phone calls and do a little investigation. That's okay. We don't need the accounting system to get us to every minute detail, but we need to get us to a point where we've isolated maybe a handful of possible causes that we can then check on and use as a basis for improving our future results. Okay, so standards. Now, this is important to get out of the way, but I don't want you to put standard costing and variance analysis in the same bucket that you have job order costing, activity-based costing, and process costing. I know costing is in the name of standard costing, I know, but it's not referring to the same thing. It's not referring to the same dimension of a cost system. So, with standard costing, we're answering the question of how we're defining our costs and revenues. Are we siphoning out variances through standard price and standard quantity? It's not referring to where we're accumulating overhead costs or how we're dividing them up to individual product units. That's what chapters 4, 5, and 6 are asking. Well, answering. Actually, that's the question that those chapters are answering in different ways for different circumstances. This is answering the question of, if we have a standard costing system, it's answering the question of, do we want to embed in the T accounts and journal entries variance accounts that we're going to do journal entries to that will accumulate variances for us automatically? And if we do, then we have a standard costing system. And it could be a job order costing system that's a standard costing system. It could be a process costing system that's a standard costing system. It could be activity-based costing system that's a standard costing system. Any of those inventory rationales for product where you accumulate product costs, inventory costs. That's chapter 4, 5, and 6. Any of those could adapt themselves to this this kind of a system. Okay, so the key is we're going to have a standard price and a standard quantity. So these are mini expectations or mini budgets, if you will. They lead to the total budgeted dollar amounts in some categories. So if we have, in order to get the total budgeted amount at the end here, end of the day, of $20,000 for direct labor, we have to have lots of expectations. We have to expect 1,000 units, that's our expected volume, and we have to have a standard price and a standard number of direct labor hours per unit. So we have our volume, we expect 2 direct labor hours per finished goods unit, and we expect $10 per direct labor hour. Multiply all those together, we get our total budget. These are the standards. This is also, in a way, a standard. We're going to treat it a little differently, but the key is this is a standard quantity and this is a standard price. You need these or you cannot break down your variances into actual chunks of information. All right, so here is where I make my definitive statement of what I've been explaining this whole time. If you want the variance to be actionable, your variance should be the difference between two numbers that differ by only one standard versus actual attribute. You want there to be one lever you're pulling between one group and group 1 and group 2, and it's the only thing. Therefore, differences in results from group 1 and group 2 have to be due to that lever you're pulling, or you can have a lot of confidence that they're due to that. And so when we get from full budgeted amount to actuals, if you just subtract these two far boxes that I'm circling with the mouse, you get the total budget variance. We need to parse that out into a price variance and a volume variance of some kind. And for the costs, we'll divide that up a little bit more. But for now, just think of it as the volume variance. So he has developed this flexible budget amount, which has a mixture of actual quantity and budgeted price or standard price. I'm going to use this interchangeably throughout the chapter. I hope it doesn't bug you. I really don't care. I think it's actually better if you understand that these terms are interchangeable, that a standard is a budget. A subcomponent of the budget. So you have the actual price and budgeted price. So that's the only difference between these two boxes. Look, they're held constant on actual quantity. Just like in my experiment, group 1 and group 2, I had to keep the goals the same. A, B, C, D in group 1 and A, B, C, D in group 2. I held it constant so that I could vary the thing that I was interested in looking at. And so, sure enough, if price varies between these two, the difference between them is going to give us the price variance. Now right here, we're holding price constant. We don't care. We don't want the price to be what we look at when the difference between these two. We want the quantity to be the difference, so we vary only the quantity. We hold price constant and vary the quantity. Actual quantity over here on the left and budgeted quantity over here on the right. And so because quantity is what's differing, the volume over here is what the difference is going to represent, volume variance. So notice that from left to right, we get from full actuals to full budget, and it goes less and less budget as you go from left to right. Or excuse me, more and more budget and less actual as you go from left to right. So if your heart's set on using these signs to determine favorability, then understand that you are going to need to look at the more actual number and the more budgeted number. So down here, full actuals, of course, are the most actual. Flexible budget is like halfway actual, and budgeted full budget is not actual at all. So if you're comparing these two, this is before the minus sign, this is after the minus sign. Actuals minus flexible budget gives you price variance, and you can use the sign to determine whether that's favorable or unfavorable. If you're doing this comparison right here for the volume variance, flexible budget is more actual than the budget. So this is on the left-hand side of the minus sign. This is on the right-hand side of the minus sign. And the difference there gives you the volume variance. And you can just use the sign as you like to determine favorability. Or if you're using me, like me, using just your feel for it, so you make sure that you get into what it means, then just whichever one is left hand in this diagram more is more in reality. And if reality is you get to have the fun of reversing your expectation based on revenue or cost, but I think you get a more robust understanding. So if we're talking about costs, then we don't want the whatever's more actual to be higher. And so here I would just look at the absolute value of the difference and say, well, in the end, actuals were higher than the flexible budget, so that's bad. The price variance is an unfavorable one. And here I'd say, oh, well, the budget was higher than the flexible budget, and so that's good. We're in the cost paradigm, like I said in this silly example that I'm giving, and so that's good. The more actual number was less than the budgeted number. So whatever absolute value for variance I'd had right here, I'd call it favorable. In part, that helps me never express a variance as a negative number. That they don't really get expressed that way. I have a table down here where I think I do have negative numbers in the Excel spreadsheet, but usually the variances are not expressed as negatives. They're expressed as absolute values with a U or an F after it to express unfavorable U or favorable F. Okay, I'll get off that hobby horse there. All right, so let's just jump into revenue variances as a nice primer. They're very simple. They follow this little mountain range with just two summits, two peaks here. They follow that. We have two big reasons why there would be a revenue variance. The price was different than we expected, or the volume was different than we expected. And so it follows the two variances that we looked at before. So price is, as promised, actual quantity, or actual unit sales, times actual sales price. That's this box up here, actual quantity times actual sales price, minus actual quantity times budgeted sales price. So notice, and that's the flexible budget right here. Actual quantity times budgeted sales price. And it's the difference between those two. Actual quantity times actual price minus actual quantity times budgeted price, or standard price. And so we've held quantity constant. Both of these sides of the minus sign have actual quantity. We've varied the price because we're looking for a price variance. And so we can actually algebraically rearrange this, pull the actual quantity outside of the parentheses, and now we have parentheses actual price, So parentheses actual price minus standard price, close parentheses, times actual quantity. That gives us our price variance. Okay, now this is actionable enough. It allows us to say, oh, our price variance is a big driver of our total revenue variance in a favorable or unfavorable way. And we then, based on the context and maybe with a little bit of digging, can find out what that means for what we should do in the future. Is this good news? Is it bad news? And what can we do to maintain and expand the good news? What can we do to limit and not repeat the bad news? Okay, with the volume variance, we have the same idea. We're holding constant the price. It's both at budgeted. For some reason, when I took the picture and typed this in and whatever, did this part, I omitted sales, but so be it. We have budgeted price on both sides of the minus sign, but we have varied what our quantity is. It's actual over here on the left-hand side of the minus sign, and it is budgeted or standard quantity over here on the right-hand side of the budgeted of the minus sign. There we go. Again, we can pull the price out of the parentheses. We have this term and this term. We can just pull them both out. And now we have inside the parentheses actual quantity minus budgeted quantity. And all of that difference there times our budgeted price, our standard price. That gives us our sales volume variance. And so, that will help us. That's an actionable understanding, an actionable number. It gives us information that'll help us understand what we can do next. With maybe just a little bit of digging, we can narrow that down to a sole cause or a pair of causes that are driving our revenue variance, that are helping to drive it. Yeah, with a little investigation, the firm could use this variance to develop a plan to improve profits next period. Now, there is a third variance. You actually can break down the volume variance into, where is it? Sales mix variance. Sales mix variance and yield variance. I'm not going to get to that. We'll talk about that. It's in 7.8 in the next video, because I want to cover it once we've got the cost variances down, because it happens in this cost variance side too. You can break down the cost quantity variances into a sales mix variance and a yield variance, assuming that your firm is a multi-product firm. Otherwise, there's no sales mix. That would be pointless. I think variance analysis is important not just for businesses, but for your personal life too. I think it's important for you to understand how things are changing in a complex environment, and to look back and see how the results have changed, and as carefully as possible to tease out the causes. And in order to do that, you need to have some pretty clear subdividing abilities in your personal life too. So, for example, as much as possible, you want to compare apples to apples. The first thing you can do for that is to compare yourself right now to yourself in the past. There are so many differences between you and the next person sitting next to you in a classroom. Your age, your sex, your experience, your baseline intelligence, your personality, your upbringing, your educational background, your career trajectory, your interests, the cellular makeup of your body. There's so many differences. And so many of those can be canceled out if you're just comparing yourself to yourself. Because guess what? Those things stay constant for yourself over time. I guess age, technically, age does change for you. But it changes at a measurable and understandable rate. And you can say, well, here's where I was a year ago. How much progress have I made in a year? And at the very least, it gives you information about what you did in a year. And sure, your age is now a year different from that, but you can measure it very easily and know, hey, I was this productive at this time period. Is that good or bad? And you can start to talk about that to yourself. Comparing yourself to the other people and where they are now that doesn't work. There are just so many variables that differ. It's a confound of enormous proportions between you and the next person. If that helps drive you and that helps get you up in the morning, first of all, you're kind of a freak of nature. But lean into that. Good for you. I'm glad you're that kind of an extrovert, of an enthusiast, and you're driven by comparing yourself to other people. I'm just going to tell you that if that does drive you, good. But I would not use that for analysis of your own life. Use it to drive, but don't use it when you're reflecting and saying, "Well, did I do a good job?" Look at whether you, with your individual differences, did a good job. Well, what effort did I put into this class? What effort did I put into the previous class? What effort did I put in this week? How am I doing in my efforts towards my family, toward my career, etc., etc.? And you can compare that over time. You can minimize the confounds in your personal evaluation of yourself in school and elsewhere.
Let's throw in a quick example here so we can go through these equations. So let's say we have actual revenue of $10,000. Let's say we budgeted our revenue to be $15,000. So we have a total budget variance for our revenue then. Of $5,000. And because it's a revenue variance, the negative sign means that this is unfavorable. You'd actually express this as the absolute value of this unfavorable $5,000 unfavorable variance. But that doesn't help us that much. We need to understand how we got the actual revenue the way that it turned out. And so let me just come up with some numbers here that hopefully all fit together. So let's just say the standard quantity, or the budgeted unit sales. That's the standard quantity. Standard is a budget component of the budget. Let's say that's 1,000. And let's say the standard price was 1,500. Let's say our actual quantity was, we actually sold 1,200, and our actual price, I want to make sure this works, so I'm going to just make it divided and make sure it's the right amount here. Okay, there we go. So this should have gotten us, our budget would have been that quantity times our price per unit, and our actual quantity times price per unit should give us the actual number up here. So this is really how it is. The quantities are going to be in total amount expected, a total quantity expected given the circumstances. In this case, we're talking about in the budget we expected 1,000 units, and here in actuality we sold 1,200 units, and the price is on a per unit basis. That gets us our full budgeted number and our full actual number. And so now we can go ahead and drill down and get our price and our volume variances. We can get price variance for revenue. Our price variance for revenue is going to be the difference between prices. We have actual first. Actual minus standard. We'll get those in parentheses. All times the actual quantity sold. There we go. If I can use the keyboard. So we have $8,000 price variance. And that is an unfavorable difference because the actual amount was $8.33 and our standard amount was $15. So we sold, because we had this reduction in price of what we sold for, almost $7 less than we were expecting, this versus this, we lost $8,000 because of that. Now, on the other hand, we had a little bit better sales. I can tell that already because I can see the actual quantity is higher than the standard quantity. So I know that the variance is going to be favorable. You can write that in beforehand. And so here we're gonna compare those two: actual quantity minus the standard quantity. Oh, we need to put parentheses in. And here we're multiplying by the standard price. And so a $3,000 favorable quantity variance, or volume variance in this case. Rename it. Sorry, I'm so used to the cost variances. I just want to throw out quantity instead of volume. But for the revenue variances, we often use the term volume instead. Okay, now if you took the sum of these with their signs still attached, you end up with the same as the overall budget variance. We're simply splitting this total budget variance for revenue into its component parts that will allow us to trace down responsibility. So let me go back and show you how these equations work. Again, we have actual minus standard price times the actual quantity. And if we go back to the textbook here, in the price variance, we have actual price minus standard price times actual quantity. Okay, that's our price variance equation. We could have just easily written it as actual price times actual quantity minus standard price times actual quantity. We got to hold that quantity constant, so the B9 cell here is the same on both sides of the minus sign here. but we're varying the price. And so we'll end up with the same number. I've just algebraically rearranged it here. Okay, and we just similarly we can also say, okay, we're going to be comparing actual quantity times standard price, which is our flexible budget. At the standard price, given the actual quantity of sales we made, we would have expected this amount, which is $15 times 1,200. That minus what we budgeted, the standard quantity times the standard price. Notice that B7 here, this cell, the standard price is held constant because we're varying the quantity. We want to know the quantity, how the quantity or volume affected our sales, our actual sales versus our budgeted sales. And so we have the same number here. You can express the equation either way, and it'll get the same number. And so that's a simple example. Now, what would we do with this? We would say, okay, why are we having such a bad price variance? And in fact, this price variance may be driving the volume variance because we sold at a lower price. The market is valuing our goods less, but they have a higher volume because they're being viewed in the market perhaps more as on a cost leadership scale. So we have higher volume, but lower prices. Perhaps we have suffered some sort of a quality defeat, some sort of bad news in terms of quality with some sort of viral video of our product breaking. I don't know. Perhaps our price that we were able to sell it for went way down. We were able to get a little bit more volume, but didn't make up enough. And we overall had a bad total budget variance for our revenue. That's one possibility. We could easily dig to see if that's the case. We could dig to see if we have salespeople who are just, I don't know, maybe we got our salespeople from the We Care Foundation, and they just care so much about customers that they're giving out discounts way too much, and it's not driving nearly enough volume. We need to tell them, no. We've got prices. Stick to the prices as much as possible, or drive harder bargains to get that higher volume. If you're going to give out discounts, it's got to be for a greater volume. Perhaps we need training incentives for our sales force, or just change the composition of our sales force. Perhaps they're too kind. You need some hard-nosed people for the sales. We could do some digging to see if that's the case. We have a number of other things we could do. Perhaps the sales manager is not managing things right, or has put in the wrong incentive systems that we can use in a company. If we find this to be a useful metric, this and these two combined rather, because now we know where it's coming from. Well, most of the bad news is coming from our price, and we're not making up nearly enough for it with the good news from volume. Then we can now incentivize the manager based off of this. You can tie this to the manager's bonus or other incentives very easily, and many companies do. So this will spit out automatically in the system. We'll talk a little bit more about journal entries in the next video, and I don't go over the revenue journal entries, but the system, if it's set up for standard costing, would be able to spit these out fairly easily at the end of each month or period, and then you have that immediately accessible for decision makers to say, well, how well did the sales manager do his or her job? And that's it for this video. Bye.